Thank you, everybody, for being here. My name is Tanaya Macheel. I'm a reporter at CNBC, and I cover crypto for the markets and investing team, as well as host our digital show, Crypto World. I want to go down our panel and have everybody introduce themselves for a little bit. Say your name and where you are and what you do.
Sure. Hi, Steve Kurz at Galaxy Digital, founding partner of Galaxy Digital on our management committee, and I lead our $5 billion asset management business.
Hi, Cynthia Bessette. I am responsible for the digital asset management business at Fidelity Investments.
I'm Fred Pye. I'm the founder and a director of TreeIQ Corp, which was one of the original Canadian companies to list Bitcoin and Ether on the Canadian stock exchanges.
Hi, I'm Mognetti. I'm the CEO and co-founder of CoinShares. We're a European company, so we far travel. We manage $6 billion for our client.
Well, it has been a pretty good year in crypto, depending on who you're asking. Bitcoin ETFs, it feels like we were talking about for so long, so much for so long, and now they're here, and I think it's, going pretty well. Let me start with you, Cynthia. How has this changed your conversations with your clients? This was, widely telegraphed and anticipated. They are here now, so now what?
Well, so we've been in the crypto space and specifically researching Bitcoin for actually over a decade now. So our conversations had largely been around education. We offered crypto custody to clients in 2018. And now with the ability to offer Bitcoin in a brokerage wrapper, we're able to really expand access to a broader range of investments or to investors across our platform, those who prefer to be able to access Bitcoin in a brokerage product, and those that would like to be able to hold Bitcoin directly on our crypto platform.
How about you? I want to hear from all of you on this one, actually.
Yeah, look, our North Star has always been how do we unlock, at least on the asset management side with Galaxy, how do we unlock two major categories of investors, the allocators, $100 trillion plus AUM globally, and the wealth community, primarily in the US, a $50 trillion plus market. What's really exciting about this moment is that in spite of the Bitcoin ETF having been so impactful to the narrative from a flows perspective to the overall regulatory discussion, the reality is those two bodies of investors have broadly not yet come into the space still. And that's a positive thing. If you've worked with allocators for a long period of time, you know that the Bitcoin event, the ETF event, requires 6 to 9 months to percolate. Then they need to figure out what it means for the bigger crypto story, why they should care, and then allocations. And so the conversations haven't really changed, but it has been a mile marker in a long 5-year process of moving in a direction where people can characterize this in a portfolio, put it through IC, have their consultants underwrite it, and ultimately make an allocation.
And then this is fun because we have more crypto native, if you will, firms represented here, as well as the traditional side. So Fred, what has changed for you since the launch of Bitcoin ETFs in the US this year?
Well, what we were hoping to see was a lot more of the gatekeepers open up the golden gate and allow advisors to really use Bitcoin as a percentage of their allocation of their standard portfolios. And we haven't seen that yet. And I think that, people are saying, well, we're waiting for, London and the US, and we're waiting for Japan, and we were waiting for Hong Kong to open up. Well, all of these have opened, but the reality is as she mentioned, education is the key. The gatekeepers are not educated on the process. The top advisors at all the biggest firms in the US understand what they're dealing with, but they're not permissioned yet to be able to buy it. So we're not going to see the real big wave until we see permissioned advisors start to buy the funds.
What do you have to add, Jam?
Well, for CoinShares, it was our first product in the US, so it was a big change. But more importantly, the data speak for themselves, So year to date, it's 117 million of net inflow per day into the Bitcoin world coming through this ETF. Before the ETF happened, the big news was MicroStrategy, Tether, Reserve buying 15% of their revenue into Bitcoin. You have real demand every day, every single week, every single month. And that's just kind of stack up at the end of the day. And, there's a filling supply. So the story is very simple there. In terms of who is there yet. We have, good things take time, and the demand will come. The demand is there. The demand is waiting. There's a lot of deprived investor in the US who has been waiting for many, many months and many, many years to be able to invest in Bitcoin ETF and other form of ETF product. And the success of this ETF at the gate, we are in the very first innings of this process, and there's more to come there.
Can I just add that so we saw, to build on the wealth point, we saw the first piece of good news on the gatekeeper side with Morgan Stanley very recently with only 2 ETFs. This also happened with the private Bitcoin fund with Morgan Stanley specifically. What you saw when Morgan Stanley first chose 2 private Bitcoin funds was a subsequent 3 to 6 months that had Goldman and PNC and Wells and many other large banks, and then also independent RIAs following that. It almost blessed the ability to do that from a job protection perspective. I think that's what we're going to see into the fall this year, and I think that that's not hyperbole or sort of conjecture. Like there are actual processes that have started, to JM's time, the point that this takes time, that have started a long time ago and that are starting to reach their natural conclusions. That's probably October, November timeframe, but it unlocks a huge, huge underlying market.
Well, let's talk about the next thing. We're here to talk about the future of your industry. And I get this so much. I think all of you probably do too, but everyone is trying to pitch me, what is the next coin that's going to get an ETF and why is it Solana? So give me a little bit of a reality check on that, because you guys were just talking about, education and how people have not, it could have opened the floodgates, but not everyone has poured in. So in terms of, when you're talking to your clients about diversification and the next, way to work on their returns, where does the crypto conversation go from this point? Anyone?
Okay, I think it really depends who you're speaking with. If you're speaking with retail versus institution, because allocation capacity is a function of the market liquidity. So realistically, beyond Bitcoin and ETH, the traditional big, heavy institutional investor are not really interested in that much. You see the 19B4 for Solana being rejected yesterday or today by the SEC. So all the kind of speculation around what can be, what can't be listed beyond a single ETF for Bitcoin or Ethereum is kind of, I would say, speculation. Even the Ethereum one is imperfect. We're missing the staking component on it. So, keeping going down the kind of cap table of or market cap of or the single coin is kind of a bit of a mute point at that point. So we need to resolve the staking component on this ETF first, and then probably keep going down.
I think zooming out, so for us, we just launched a partnership with State Street. State Street has not yet made a move into crypto, and that is not about the next coin, irrespective of our views on that process. It's about the 75 equities, securities that are now linked to crypto. The fact that there are futures, there are options, there are crypto ETFs, there are all kinds of exchange-traded vehicles globally, and the accordion has expanded so much in just 1 year that you can start to have active strategies. And so while that's not what I think the average crypto asset manager would say the path would have been, that is a path that brings crypto awareness and crypto education through a different set of tools in the toolkit. And that's part of this panel, is the future of crypto asset management. That's not just crypto, the coins, that's also the derivative ways that crypto expressions can happen in a portfolio. So that's one example of something outside of just the coin exposures.
All right.
So maybe I'd add a corollary to that, and there's a little bit of an education component that comes with this as well, is, as we think about how to, talk to investors and educate investors about this broader ecosystem, it's not individual token by token, but rather, right, as asset managers, how do we think about portfolio construction? And from there, how do we create exposures representing different sectors within this growing ecosystem? And that's where, from an asset manager standpoint, there's an opportunity for us to be able to add value beyond just individual access to some of the largest crypto tokens.
I think there's 2 components that I have to bring up on this. Is first of all, for my regulated investment brokerage accounts, I can still buy the CoinShares Solana ETP, staking ETP out of Europe. And I think with the global platforms, like people could have bought a Bitcoin ETF in Canada 3 years ago. and our Ether ETFs do stake in Canada, so do our closed-end funds. So it's just the U.S.-centric is a little bit behind. But I don't think until you get widespread adoption in Bitcoin and Ether that people are then going to start to look and say, okay, I know I've got my market weight of Bitcoin and Ether, but there's now 30% of that market that's going to be in the alternative coins. And I think when you start to see the blockchain use cases be significantly more prevalent, let's say XYZ stablecoin is going to be written on Algorand, for example, or Stellar, which were both here earlier on this morning, and Avalanche. So any one of those three, I think I've got everybody but Paxos, but whatever blockchain that those major use cases will be lit on, then people are going to say, you know what, I don't mind having USDC, but I want to own the blockchain that USDC is written on. And I think that's when you're going to see that broad interest broaden out. And we see in our side of the business hundreds of businesses doing real world blockchain applications. And we heard a bunch of them this morning from the other group.
The tokenization of so-called real-world assets is something that comes up for me a lot. It comes up in bear markets, and then it tends to kind of go away when prices are catapulting again. But it has not gone away this year. Before I move forward with this, why do you think that is? Do you see this trend as more real now than it was before, or maybe we're just more advanced now as an industry than we were before, and that's kind of all it is? But what do you make of that?
Well, the missing piece was obviously the large asset managers. I mean, you always had the ability to create a token or the ability to wrap a token. I mean, 6 years ago, we were all high-fiving in the crypto space because we tokenized an Aspen hotel. It's like, okay. And so building the buy and the sell side of the market is really hard to do when you don't have, a center of gravity that has real pipes. So I think what has changed is that for the last year, every major asset manager has a plan for this. Some are in different parts of the world and different structures, but the widespread recognition that just like ETFs after mutual funds, the tokenized wrapper broadly will be part of the future is very important.
Can you say a little bit more about why?
Why it's important?
Yeah.
Well, I mean, in a bigger picture, theoretical sense, it's important because it's the first step towards unlocking the true value of what a token can do. There are a lot of steps between a tokenized money market fund, particularly in the U.S. with restrictions, and what tokenized capital markets with embedded smart contracts can actually be. But that's the same thing as saying the Bitcoin ETF is bad because we don't have in-kind create and redeem. We will have in-kind create and redeem for the Bitcoin ETF. It's just the first step along many towards that path. The democratization of finance use cases, the 24/7 markets, the transferability and efficiency, those are obvious points, I think.
I think you were about to say something.
Okay. Yeah. I'm smiling because, if you think about 5 years ago, we had an audience in Canada. We had a group from a major global asset manager sitting in the room with about 60 people from a major Canadian chartered bank. And we had tokenized a $4 million bond position. We put $4 million of tokenized bonds in one wallet. We had $4 million of QCAD, or digital Canadian currency. In the other wallet, we told everybody to blink. They all blinked. And the $4 million of bonds was in one wallet. The $4 million of QCAD was in the other wallet. We just said, we just did a $4 million bond trade in under T+2 seconds. And if you look at Etherscan, that cost us 0.2 pennies. And you could hear the entire room just groan, going, oh my God, there goes, all the friction in the bond market, can disappear. And that was 5 years ago. So adoption is not quick. That technology is there now. We can tokenize anything. And you'll see real estate first, and you'll see insurance second. And then obviously there's tokenized gold everywhere now. But I'd like to see tokenized funds in our ETF so we can trade them out of proper wallets. I'd like to see that happen first.
And are clients saying anything about that? I mean, you work in, a client leading business. So is this something that you hear about from clients, or is this a situation where you guys are sort of innovating before your clients know what they want?
So I think there's two things that I would say on your first question, which is, why do we think that now is any different than 5 years ago? Now we are more focused on concrete use cases, which I think is incredibly important to demonstrate utility, because clients are calling, asking for digital assets. The second point I would say, and maybe a part of the chicken and egg issue here, is there's not infrastructure, wallet technology, right, that's proliferated across investors that makes it easy for them to be able to see digital assets and traditional assets side by side, and be even for asset allocators to be able to think about how to construct a financial portfolio or a financial solution that then can take into account the broader range of assets available through tokenization. And when you see infrastructure and a focus on concrete use cases, this is the long journey, and this is building those use cases and the infrastructure to support that as we look at more integration of digital assets and traditional assets.
Just to reiterate on this point, I think when it comes to the client always look at it and say, what is the benefit for me? I've been running fund for 25 years this way. Why should I use a tokenized form of this one? What is the added value? And so if all of a sudden you can tell them, well, your repo trade, you only need it for 8 hours and not for 24 hours. So you can only pay the price of time for 8 hours because it's not tokenized. I can settle as spread, say, in T plus 2 seconds. Then all of a sudden the math becomes very interesting. Of course, if you're a retail investor, not very interesting, but you're a $2 billion manager, all of a sudden the overnight position you have for just a few hours saved on your cost of time become very, very interesting. So it's all about where is the value add for investors. If you are a private equity investor and all of a sudden the secondary market become much more liquid because you get price discovery happening in a kind of seamless way or more or less clunky way than it is right now. It's all this kind of use cases which need to be demonstrated and explained to investors so as the demand comes. Like the Larry Fink moment was important. You get Larry Fink coming on TV saying the tokenization of assets is the biggest stuff we're going to drive the industry. So obviously when he speaks, everybody listen, and that's kind of an obvious statement. But so the trend is moving. 5 years ago, or even 5 years ago, the industry were not even looking at real world asset that much. It was all about DeFi. Then interest rate goes to zero, and it's all about how do we bring yield into crypto, and then real world asset become a real story. So again, we tend to give not enough time to crypto to evolve. We forget that companies like Amazon are very, very old company already. And when they started, you didn't imagine they would have planes on the Jackson runway. So it's kind of a very, very kind of a different time to market. And crypto is in its so in the infancy of this project, there's plenty of stuff which is going to happen over time. And we're going to see how effectively the blockchain infrastructure transforms the way people consume financial services.
I actually want to stay with you, JM. So I'm sure you all saw the news yesterday that Bitwise, who I think is in the room here somewhere, acquired. Hey, Jeff. Acquired a London-based ETP, announced yesterday, and $1 billion in AUM. Where do you see this trend going? How much consolidation, and at what point from here do you see that M&A trend kind of accelerating?
Congratulations to Bitwise. I'm not going to say anything else. Welcome to Europe. It's a nice little place, so you're going to enjoy it, especially Germany.
He doesn't have a mic. You got to give him a check.
Anyway, all things being equal, the industry has evolved a lot. There's a lot of asset management platform today. Like we saw to some degree with like exchanges, you're going to see some M&A activity happening in crypto asset management as well. Like, Fred is the best example of that. Fred and his Japanese colleague managed to do probably the first asset management transaction of size in history in crypto. So it's just going to keep continuing. At some point, it is the economy of scales. You saw it in traditional finance. You see traditional hedge fund getting bigger and bigger by bringing PM and bringing AUM into their own book. A lot of this company grew by acquisition in traditional finance. The same thing going to happen in crypto.
And then getting into the profitability aspect of it, I mean, we've got all these Bitcoin ETFs in the U.S. now. I think for many people, and we have to reality check ourselves sometimes on how new this space is and how much of insiders everyone in this room actually is. But they look a lot like the same, I think, to a lot of people, other than maybe the fees. So how do you see that fee war playing out, and what does the asset management space have to do to achieve and maintain profitability? Fred?
Geez, you hit right on my pet peeve. Obviously, my company can't compete with BlackRock in terms of managing the fees and giving the fees away and everything else along those lines. But we try and emphasize, and all we can do is say there is very little correlation between the exact management fee and the actual performance. And in fact, after the first month, there was something like 300 basis points performance difference between the top ETF and the worst one. And now there seems, after 3 months, it seems they're getting a little closer, but there's still some outliers there. It's, we don't know what goes on behind the scenes and them absorbing the costs and whether that's legal or not. But managing the cash flows and everything that happens is, it's a challenge. I think what I like to believe is I believe that, there's a lot of great companies. Obviously, Galaxy, we've been clients and friends of for a long time, and my relationship with Fidelity is surpasses decades. These are all great companies, and I think people should not be looking at initial management fees as much as, stay with a provider that you trust, that understands the space. Everybody at this table has been in the space for a very long time. I know Galaxy's been there 10 years, CoinShares has been over 10 years, we have been over 10 years. And Fidelity, Abby has been in it, Bitcoin mining in her office for over 10 years. You've got the experience that's on the table here. Yeah, we don't have the bench strength of BlackRock at this time. I mean, some of us do, but I think that, investors should stick with the providers that they're loyal to, and, go home with the girl you brought to the dance. Yeah, where I look at it.
I think there's always room for specialists. I think the way to be, so some of these single coin products, while they're not interesting on the fee side, it's table stakes for being an asset manager in the space. I agree with Fred. Our approach has been to partner with large institutions. So we're partnered with Invesco in the US, and now State Street and Itaú in Brazil, and CI in Canada. And so we've taken a distribution, a subject matter expert approach to the ETF part of our business. But if you're looking at the profitability of the asset management business in a platform sense over the next 3 or 4 years, it's about moving into more alts products. So obviously hedge funds, liquid token funds, venture funds, fund of funds, those are all models that are being tested. And you really haven't had a true asset management industry in crypto. It's been a cottage industry until the Bitcoin ETF happened. And so I think as you have all these securities coming to market, the way that I said earlier, 75 equity securities, for instance, active management becomes part of the conversation, and your differentiation isn't on fees or total cost of ownership. It's now on what strategies are you creating, what alpha are you generating, and that's when we know we've actually achieved something in terms of it becoming an asset class and crypto asset management becoming a real industry.
And you've said that this industry is experiencing or is about to experience a renaissance. Is this what you're talking about?
I think so. I mean, with a 3 to 4 year lens, there is a path to not just 100, 150 billion in asset management in crypto, which is broadly where we are today. I mean, this can be 5, 6, 700 billion of AUM, which is a real place to build a business, and profitability will still be hard because you're going to have to compete and earn. But that's the same thing as in every other asset class, whether you're a hedge fund or an ETF provider or a private equity shop.
And let me just add on to your point about specialists. This is, talking about the crypto asset class, this is a new asset class, and it is extremely complex. And for any asset manager that is looking to be able to add value and deliver new investment capabilities in this asset class, there's an infrastructure investment that needs to be made. And that's where the specialization comes in. And that's where, whether you are a boutique that has the expertise and you're building that infrastructure to be able to invest on chain and build your data platform and your research platform, which, by the way, doesn't look anything like a traditional securities-based investment platform, that is a specialization. And so whether you're a large asset manager or you're a specialist asset manager, that's a point of differentiation as we're going to clients and explaining what this asset class is, how to actually invest across this asset class, and what we as asset managers can deliver through education, as well as creating those portfolios and investment exposures.
So let's stay on that, because I wanted to go back to portfolio management and allocation. The soundbite is 1% to 3% Bitcoin, maybe ETH. Obviously, this just depends on who you're talking to, but are we still there, or are we getting a little bit more aggressive? And I'll stick with you, Cynthia. What do you hear from clients? Like, are they interested in becoming more aggressive, and, Fidelity has to kind of temper them, or is everyone still kind of on the conservative side?
I'm going to take a page out of what JM said earlier. Is it really depends on the client. It depends on where they are in their investment journey, and it depends on what they're looking for. And so as we think about building out a platform with a range of products and a range of ways to be able to access this new asset class, education becomes paramount, and making sure that investors understand through the research materials that we provide and education modules to understand how to access this ecosystem and how it works. Then we feel like we're arming investors with a more knowledge-based approach into how to think about ways to enter this ecosystem in their portfolio allocations. And this applies from our retail platform, where we do provide a tremendous amount of education to investors on the platform, through to intermediaries, and having conversations with intermediaries. We are able to go and provide more of that portfolio allocation advice and more around how they can think about, depending upon what investor they're talking to and how they're looking to construct a portfolio. So what is the risk tolerance of their underlying investors, and then how to construct that portfolio accordingly.
And then what about for our friends with some more crypto native clients?
If you zoom out and you look at what happened in the market before, you look at, I'm a commodity trader by, that's where I come from. And, when I started the GSC, I was a new kid on the block. And a little thing about, a summer having paperwork on crypto, on a commodity was a big step, but there was no allocation in commodity per se. And all of a sudden you see 1%, 2%, 3%, recommendation for 4 to 8%. And it took, a couple of 10 years to all of a sudden every single multi-asset manager had a commodity allocation, if not a commodity PM. So it kind of happened over time, but in a very kind of progressive way. If you remember the private fund allocation, a couple of years ago, it was like the new frontier that you need to absolutely get private illiquid investments in your portfolio to be able to benefit from this kind of private round. The recommendation was around the time 10%, and at the peak of the bubble, it was 35%. I just say, well, like everything, the pendulum overswing and kind of correct naturally. Right now, we don't even start it, so it can only go in one direction. The fact is very simple. Whatever amount of Bitcoin you put in your portfolio, whatever the form, an ETF or Bitcoin natively, you will always improve the Sharpe ratio of a portfolio. The math can't be defined on that. They are very stubborn. So the fact are stubborn, just like you need to play where is your risk tolerance after that.
I think that, I'm going to step in on that, because obviously all the CFAs, all the gatekeepers at all the big, the big firms that are rejecting digital assets are all proponents of modern portfolio theory. And as hedge fund managers, we've been on the quest for the perfect non-correlated asset class for what? Decades. We finally find one, and now they try and parade out every excuse on why you shouldn't do it at all. I think people will start to understand that you can buy every type of hedge fund now in digital assets. You can buy market neutral, you can buy leverage, you can buy loan portfolios, you can buy every combination of portfolios, of which we have a great package of a bunch. But the reality is any actively managed portfolio is what we call a hedge fund or accredited investor, a sophisticated investor. You don't have to convince somebody under 40 that they should have a good position in multi-strategies and digital assets, but under 40, they don't have the necessary amassed $1 million or 150,000 as a minimum investment. So, we're kind of shooting ourselves in the foot. So I think all of this is going to happen. You will have public, great mutual fund companies that will have actively managed digital asset mutual funds. And I'm saying within the next 5 years. And I think that that's when you're going to see broad acceptance of this entire technology.
I think on the hedge fund and active side, that's true. I also think that we have to be reflective as an industry. We haven't done a good job of that generally. Market neutral in 2022 was a disaster. And the not to say it's not possible now or that there aren't good solutions for that and it's getting better, but some of the brain damage of pre-FTX allocators going through a process and then just having that blow up in their face multiple times. Even if they didn't make the allocation, they can't unsee what they saw and experienced. And so I think there's a credibility issue that has to, it takes years. You got to build track record. You need to do what you say you're going to do and actually prove alpha. Just having benchmarking for that was not something for a long time we had in the space. So it's happening, but it's not a straight line.
We only have a few minutes left. I'd actually like to go down the line, starting with you, Steve. The biggest headwind and tailwind for your industry in the next year?
I mean, the obvious one. No, I guess I could say regulatory. The biggest tailwind is that most of the headwinds of a year ago, in my mind, are either improving or behind us. Regulatory is on the right path. Even the tactical stuff that we've seen, the overhang on the markets is going to clear up. We're going to have FTX distributions into next year that are going to go into crypto. And broadly speaking, we have way more credible providers of crypto infrastructure, whether they're crypto natives or institutions, that are all coming together and building things. So I think the next 2 years is just a combination of all of that. Obviously, the biggest headwind is making sure that we keep our identity and our principles as crypto people in the context of this regulatory battle. Like things being positive doesn't equal positive outcomes, and so I think that's the balance that we have to really be careful about.
So everything that you just said, I agree with, and I would say patience for the long game is both a headwind, patience for having that regulatory clarity, patience for seeing more infrastructure being provided across more established financial institutions, which is going to facilitate that headwind of mainstream adoption and that institutional adoption. So continuing to focus on concrete use cases and focusing on access through more infrastructure.
I'm going to say, obviously, the tailwinds is exactly what JMM was talking about, before. There's more buyers, and, I've been in the business for 45 years, and more buyers than sellers, and strong demand and flat supply, to me, is economics 101. This thing's going up, and I think, get ready, it's hasn't even started. If you look, it took most of us 14 years to get our first email, so 14 years to buy our first Bitcoin, that's okay, too. I'm not worried about that. So we've definitely got the tailwinds. Clearly, you need people with experience such as us to battle the regulatory, headwinds that we have. 2 talks from now, you're going to hear Christian Carlo and Jay Clayton talk about how we're going to solve all the regulatory headwinds. And you want to be long by the end of that speech this afternoon. So open up your wallets and start to buy. Headwind, I think the biggest challenge when the markets know this kind of appreciation cycle it has is to stay disciplined and don't be complacent. Because that's when the mistakes happen, that when you make errors, and then when the sense of appreciation makes you take risks you don't appreciate very well. So the unknown is kind of a very, very
important item which keep probably most of CoinShares kind of management awake at night. Say, or how do we protect our investors from the kind of next risk we didn't think about? Like when FTX happened, nobody was thinking FTX was a fraud. People thought it was a liquidity gap and it can be plugged in. And plenty of people in this room were working on finding a solution to plug this gap at the time until they realized it was a fraud. So as the cycle is about to restart, is how do you keep this kind of discipline and non-complacent approach to your business? The tailwind, the regulation is moving, whether we like it or not, is moving in a direction which is not going to be perfect, but will allow us to engage on a better way with many, many investors, whether it's in the US, after probably the presidential cycle, but more importantly in Europe as well, in Asia. So you start to have like a regulatory pattern which start to emerge across the world. And the US, as usual, will requalify very quickly if they're a bit late. So I'm not too worried for the US. So, in all honesty, it's like really focusing on staying, truthful to our value and who we are and our identity as crypto native company, and don't move away because the cycle is starting again.
And on that, Cynthia, I'm actually curious. So obviously, it's not out of the ordinary to see a 30% pullback in a bull market. We have had a lot more volatility this month. I think, we expected August was going to be a little bit sleepy, type of trading, but it's been pretty volatile. Any feedback from clients? Are they just kind of taking that in stride, or are you seeing clients kind of spooked by this volatility this month?
So following the most recent event, we prepared a number of remarks on what we've observed in the market, focusing on keeping a long-term view on your investment and thinking about your portfolio holistically over the longer term. These assets are by nature, as you pointed out, highly volatile. There's a tremendous amount of disclosure that we ensure that investors are armed with as they're entering these assets. And so we continue to focus on the longer term, and we've seen more than a few of these drawdowns in the crypto markets over the last decade. But that hasn't changed our view in the long-term belief in this technology and in the long-term belief in this asset class.
How about your clients?
It's been pretty, if you look just on a flows basis as an indication on some of the more liquid products, we've actually seen some inflows on the back of that. I think at this point, those that have been with us for a long time are used to this, to Cynthia's point. And I think those that, those that are on the more sophisticated or allocator side, this is exactly why they want to have an active management approach or have a venture approach, which is less liquid. So it just, across the three buckets, it's been broadly okay.
Bitcoin has given us something that CNBC has worked on before and identified to its precision is the Bart-Simpson chart pattern and the inverted Bart-Simpson chart pattern. 2 days ago, Bitcoin was 58. Yesterday it was 61. Today it's 58, 59 again. It's a perfect Bart-Simpson chart pattern. And we see the opposite. Get used to it because it's a 24-hour industry that trades all the time. And, clients are very used to the patterns that we're seeing now.
I'm going to leave it there. Thank you so much to our wonderful panel, and thank you to everyone in the audience.